In the looming specter of a second dip in the recession, clear, strong economic planning is needed if capitalism is to survive. Right now, governments and economists around the globe are working frantically to uncover the key to survive in the continual crisis of capitalism that began with the U.S. financial crash in 2008. Despite the rhetoric spouted by free market fundamentalists, clear strategic planning will be required if markets of the world are to survive. What is needed is a plan and leadership in its implementation. Capitalism is a system designed to compete, not cooperate in order to sustain itself. So what happens when all the conflicting interests converge in one important global event? Without leadership, there will be only disaster. The chaos of the market cannot be allowed to run free. In times like these, the state must take leadership and guide the sinking ship of capitalism into shallower waters. A great helmsman is required. It seems China is the only one to recognize this need. The sovereign debt crisis in Europe is a major force in the looming second dip in the recession, according to the International Monetary Fund. Current President Robert Zoellick has already said that urgent measures are needed to avoid future problems. Decisive action is needed in the U.S. and Europe to prevent any major shakes to the global economy. These experts said that despite developing countries growing at 5 to 6%, vigilance against crisis is still greatly needed. The IMF has recommended that the U.S. and Europe policy allow the lower-income countries to rebuild their strengths and policy buffers that existed before the crisis, but since then have been destroyed. Usually the world turns toward the U.S. as a world leader in economic thinking and leadership. However, as of late, the world has begun growing unsatisfied with the inability of the U.S. to come up with a contingency plan. Right now, the U.S. Fed is talking about undergoing a third round of quantitative easing, along with further harmful spending cuts, a measure that has failed to stimulate the economy twice before. However, the Federal Reserve Board is claiming that the third round of quantitative easing is not that. They are saying that they are selling short-term securities and buying long-term government bonds in equal amounts. To them, that is not quantitative easing. In my opinion, and the opinion of the Brazilian finance minister, it is very much creating more fiat money. With the second repetition of a failed measure, many are becoming of the opinion that the financial elite in the U.S. are at a loss for a solution. With this lack of leadership from the United States, many around the world and in the media are calling for leadership from other countries and financial analysts to fulfill that role. A lot of experts have been asking why this is happening to begin with. The question being thrown around is, why didn't we see this coming? In the financial community, they're blaming bad oversight and poor planning. However, I believe that is only half the story. The fact is, capitalism and the global actors themselves don't plan. Each individual banker or investor doesn't get together and plan out their investment strategies with one another. Well, that would defeat the entire purpose of capitalism itself. The reality is that the financial community, both locally and globally, did not plan anything. What they did in reality was chase any idea they came up with to get as much money as possible in the shortest amount of time. Any such impulsive behavior will inevitably cause problems. This is the result of the chaotic nature of the market and capitalism itself. Right now, U.S. President Barack Obama has proposed a balanced plan for solving the U.S. debt crisis. The plan would be the elimination of $3 trillion in debt. He has proposed ending a portion of the wars, saving the country $1 trillion over 10 years, with cuts to government spending of $500 billion on Medicare over the next 10 years. These two combined efforts would eliminate half of the immediate debt problem. The other half would come from raising taxes that were cut during the Bush administration that had a huge hand in the creation of this current debt crisis. It does bear a reminder that Bush was the only leader to ever cut taxes during a war. 2 wars, in fact. Now, if the U.S. can eliminate this $3 trillion of debt, it would greatly increase investor confidence in the global situation. A return of investor confidence would have a positive impact, and we have to keep in mind that how the market is viewed is often more important than how it actually is. Now, this third round of quantitative easing, or selling short-term securities and buying long-term government bonds, as the Fed is calling it, will create more liquidity for the country and will further expand the money supply. This expanding of the money supply will not tackle one of the most pressing issues, the mass unemployment of American workers. If these workers can be given jobs, then they can be taxed and can contribute to reducing the debt. The problem is that the consistent policy of cutting taxes to start new or expanding businesses, which means that collecting less taxes when it's needed to be collecting more. The usual defense for this is the claim that it will work because those new employees will have taxable earnings. That is the theory. However, in reality, The reality is that these new jobs will almost certainly be minimum wage jobs, probably part-time in order to save the business owners money, meaning those new employees will probably not make enough to be taxed, defeating the entire purpose of the tax breaks to begin with. These tax breaks are a meaningless gesture anyway. Those with enough money to invest are unlikely to invest in American facilities anyway. Investing in the same facilities in China is a far more profitable venture. With the exchange rate of $1 being equal to about 6.5 Chinese yuan, it is far more profitable to invest in China. The reduction of domestic taxes still cannot even come close to the amount of money that can be saved by using Chinese labor and equipment. China right now is suffering from the same problems as India, Brazil, and other such emerging markets. Too much loose money and low interest rates are having a negative effect. Expectedly, that new money created by the Fed will flood into China, and the rest of the investors will be taking advantage of the cheaper labor and materials. This builds asset bubbles as foreigners begin to invest. Once that money begins to flow out, possibly as quickly as it came in, it could trigger a local recession. This new money coming in also raises the inflation rate as well. Luckily for China, it does have a strict capital control, which will help guard against the situation as it has in the past. China's state having a hand in the flow of capital coming in and out, helping protect it from harm, a defense that a truly free market most certainly would not have. One of those ways would be raising the value of its currency. On the contrary, it is a measure China has recently been avoiding taking. Many in the international community, especially those in the emerging markets, are calling for China to take the lead in world finance. China is the world's second largest economy, having surpassed Japan, and has investments in almost every country in the world. Many have been speculating that China may offer a hand to those in South European nations that are struggling right now, like Greece. Commentators are pointing to the fact that China has the world's largest foreign exchange reserve, but China maintains that that's their safety net in case they are pounded by a second dip and are unwilling to risk it. Besides, despite the substantial gains that they could make in doing so, they feel that they do not have enough liquidity to offer a bailout, which I think is true. After all, China already holds so much U.S. debt. It would certainly be dangerous to take on any more. What needs to happen is for someone to come along and give a solution for this problem. The world's bankers and central bank chairmen are really at a loss for words. There is no solution, and I think they realize that there might not be one. The only thing they can do right now is try and keep capitalism afloat, not save it.